Hey guys, it is the last day, month end, April 29th, and it is a crazy day in the markets as per usual. Okay, let's get into what was going on today. Past performance is not indicative of future returns. I do want to let you guys know that there are some really cool things that we have going on at Gurula. Namely, we've got this awesome conference that is coming up on the 15th of May. And then obviously my great friend, Rich, who does a fantastic technical show first thing in the morning. And also if you're wanting to be a day trader instead of an investor style, I really think people should have a little bit of both going on in their portfolio. He's going to be the guy that you're going to want to definitely check out because he's quite talented at what he does. Okay, let's go through it. We're going to go through the economic news. We're going to go through a bunch of earnings reports that happened. Of course, we have Intel and we have Amazon that have occurred. And it's very exciting. There's so many earnings that are happening, but most of the large cap earnings have occurred at this point. Let's make sure to go into it. Today, PCE inflation came more or less what we thought it was going to be. And from the energy earnings that came out today, Exxon, Mobil, Chevron, it doesn't look like things are letting up anytime soon because those guys were very clear. We are not going to buy a company. We are not going to do anything other than try to organically increase production because we've already learned our mistake in the last time that acquisitions done in a bad environment are bad acquisitions. A bad economic, unlike tech, where if you see the trend, you want to follow it. The oil companies are like, no, that's the wrong call. If I buy an acquisition at all-time highs, when the price of oil declines, that is what we call a bad acquisition. So they're just not doing anything on that front. They are proving out reserves, pumping as much as they can out of the ground, but we're only talking about small 10% increases from what they already had from the majors. So we're not going to see this massive increase from them. So it really comes down to the onshore folks who report next week to tell us what's going on, what can they do in what amount of time. Again, it is a very tenuous situation that we've got right now because we are going into the summer months and we don't know what Mother Nature is going to do. So that is what we're setting up for. I do want to remind you guys, even with the VIX hanging out here at 16.5 and you're like, oh, should I let it go? I think maybe you need to wait just a touch because we do have the FOMC meeting that's going to come out, the FOMC statement, and then he does a news conference afterwards. Now, I really think that whatever he's going to say, the market kind of already knows as far as that goes. He's kind of been very much on message. So it's just whether or not we have this continued reaction to every single little thing that he might say that is already known, oddly enough, in the marketplace. So be aware of that. That can cause some sensitivity. And then we do have a lot of companies that are going to report next week, a lot of them in energy. So know that Clorox, which I've been kind of short on, I lightened up a little bit on my short but I am still short this name because, man, I just don't know what their raw material costs are going to be. Again, Clorox is one of the most expensive consumer staple names, trading well over 30 times. And that's having guided down last quarter. You got to really believe people are going to buy their products. And, household cleaning supplies, people bought a lot of them during COVID. So it's whether or not they can get pricing through, given that folks are probably carrying a bit of inventory. Now, at some point that'll flip back, but, that kind of is what it is. And then we've got a lot of the travel guys reporting, and we've got some consumers starting out next week. So next week is a big travel week. It's interesting because Vol's kind of tampered down a bit on some of these names with the airlines coming out, being very clear that domestic travel is absolutely picking up. I, being on a flight this weekend, can tell you the plane was full and they switched my flight 3 times, or I'm sorry, they switched my seat 3 times because they were just trying to rejugger passengers and really maximize the plane. So it's really something special going on right now. All right, we're going to talk about Amazon, and then I'm going to come back around. That was a terrible quarter. And for the first time, I think people are actually starting to recognize how bad it really is at Amazon. This is the numbers I really want to show you. AWS is still doing really well. So that was my concern, is that the market would just, again, ignore the fact that North America and international, like everything outside of AWS, is ultimately in composite losing money, and that they would just ignore that and be like, oh, AWS is awesome. And yeah, it is awesome, but it's got to pay for all of this other stuff. And so that, unfortunately, is still, I mean, you could see how high the fulfillment charges are increasing. That's oil right there, okay? And then you still have cost of sales going up. Now, some of that is AWS, but most of it really is the fact that labor costs, we all know what's happening at Amazon there. So this is not looking good. And there's no real change as far as the timing. So from an options perspective, I keep hearing him say every quarter, hey, I'm not going to really know until the third quarter, and maybe we'll get lucky on some raw material costs or some, energy costs declining. And as you all know, I don't see that at all in any way, shape, or form. So realize that a bet right now to be long Amazon is a bet that you believe that the oil price is going to go down in the second quarter. That's really what you're betting at this point. You are not betting anything else. We should not be confused that you are doing anything else other than betting on oil synthetically through Amazon, because that is really the only thing that can take them up, unless you somehow magically believe the consumer is going to do something crazy and buy from Amazon all summer long versus going out and buying from a store. So if you believe that, okay, cool. Hard to say, but that's what I'm seeing. Maybe because of energy costs, people would prefer to buy by mail, but I just don't see it, because I think still, if they're going to pass through costs a particular way, whether they pass it through to the seller, which I know they're doing, or they pass it through in some other way, I think it actually gives a store a shot if they're primarily doing transportation. They're not doing that last mile delivery. So it's an interesting call, but that's really what it's coming down to right now with Amazon. I do want to mention something as well that you should note as relates to a new dynamic in the supply chain. This is United Rentals, and they did fantastic this quarter, but they didn't do it by renting more equipment. They did it by what they call improving the quality of their earnings, which means rent less equipment, charge more, sell old equipment. That's what they did. That means literally that it's going to be more expensive to make things going forward, because United Rental, it rents to everyone across the entire world. They have a huge business in every single industry. Now, we've already talked and heard about the fact that the energy sector, the energy equipment guys, they're out of equipment. So that's part of who's buying this stuff. So it is a very strange environment that we're in. And that really, in my opinion, is because of steel prices, which we are seeing really clobber anyone that has to buy steel. And so just be aware of that. Whether it's an auto company, whoever it is, this raw material thing is a big issue. Again, steel made out of iron, a big thing that is made out of Ukraine and Belarus, who we are economically sanctioning along with Russia. So just realize that's the case. And then let's see, the other thing that I have to mention is Intel. These things are known, but people are still reacting to them. What I really want people to see is this foundry number, which I think goes unnoticed. Now, so the numbers still look cosmetically bad. Top line, bottom line, very well telegraphed. And certainly the stock is trading so beaten up that it is absolutely demonstrating that it is in the middle of a turnaround. That said, I just want you to see how high the foundry services is versus last quarter. And this is where we'll see the pickup. Now, client computing continues to be down aggressively. Every other part of their business is doing well. Client computing, it's been known that that's weak. That's why we're seeing weakness in other names across semiconductors. And also now, interestingly enough, Mobil actually managed to be up, and that's more cellular related. So it's a very interesting, mix of what we saw in Intel at these levels. Let it kind of settle, and especially with the Fed meeting coming up on Wednesday, the Fed news, which will probably be a big nothing, but I think this market is going to be a little choppy and dicey for the next few days. At some point here, though, I think you want for long-term holdings, and I think you do it through equities or you go way out on the leaps. Intel is a buy, but again, it's still going to be choppy here for a bit. Okay, now for things that are a little bit more intriguing and positive, Robert Half gets no love, but I really want to show you these numbers. And I think that it gets no love because people are preemptively selling Robert Half, thinking the economy in the US is going to weaken. Robert Half, as many of you guys know, because I do talk about it quite a lot, is a company that essentially does staffing. It is now traded down about 20% since the beginning of the year, 15-ish%, something like this. This is Robert Half's earnings, okay? This is like up some ridiculous percent, like 60%. Bottom line, also doing fantastically. Do you know what I'm saying? This company, and then they're just buying back stock. They're buying back stock. That's why diluted net income per share is higher than even net income on the increase. And they will continue doing that because they're making a ton of money. They get economy of scale. And it was a really interesting call. So top line up 25%, bottom line up 55%. Sorry, I had it written on the slide, so I didn't need to do the math in my head. But so margin expansion, the county attempts business, they lost one client, and so everybody freaked out, but it was not a big deal. I mean, this thing trades well below the multiple that makes any kind of sense at this point. It is cheap. And it doesn't have a lot of liquidity. So this is one for the IRA that you just sit there, let it do, because there really is some changes that are happening. I am seeing about, whereas usually, or since COVID, it's been about 2/3 of the companies have been doing well, and 1/3 have been not doing so well. This quarter's very different. I have about half of the companies doing reasonably okay. Like maybe they lost a little bit of margin, but we're still seeing very strong top line growth, and then just a little bit of margin, but still growth in net income. Not this quarter. We're closer to 50%. I'm through about 112 or so companies, and some of them are legitimately doing poorly, but the market isn't coughing up those names, it's coughing up other names. So I will absolutely keep you guys posted on that next week. So I should have closer by Monday, hopefully, but I'm still enjoying my time with Warren Buffett and folks. But we'll have some time by the end of next week, closer to 150, 200 companies that we'll have listened to and report accordingly. Anyway, Robert Half is one that you're going to want to put on your radar screen and think about what metrics make sense for your personal investment. To me, it's probably cheap here, but you could probably slowly acquire it, and definitely be very careful buying things until the Fed comes out, and really watch the kind of ebbs and flows of this market in the first week of May here. Also, remember, as we move into May, trading activity is very strange because a lot of people sell in May and go away. Do you know what I mean? So you have probably the entire summer to slowly acquire what you'd like to do in the fourth quarter. Okay, but Robert Half, great quarter, got sold off. I have no idea why, to be fair with you, other than that one little thing that I mentioned, which is the loss of a single accounting client, which they are more than making up for in literally every other aspect of their business. Okay, Twitter. I want to talk about this, and I will do a separate video on this. I've had people really upset with me because they feel that this is just a terrible company and there's nothing Elon could ever do, and who would buy this, et cetera. You know, I'm going to do a little bit more on this because I'm that kind of person where I'm like, you know, Elon, I'm not the biggest Elon fan. I'm not a fan. I respect the man for his business acumen, which is way beyond my own. So, you know, I don't so quickly when he does things just discount the entirety of his brain power. I do want to mention the following. Again, this R&D number is crazy. I also want you to know that in SG&A this time, this big uptick was basically management paying themselves in stock. And you can see that in the cash flow statement. Stock-based compensation was up by 60 million, so $60 billion. It's ridiculous. Okay. And, you know, one of the things he said was, I would just pay management nothing afterwards. They would go to $100,000 until this company became more profitable and just a better company. And I want to give you a sense for this. 1.2 billion is what they made in revenue on the quarter. TikTok does almost 1.4, so 1.3 and change, okay? TikTok has 1,600 employees. Twitter has 7,500 employees, okay? What are they doing? You know, I want to know, what are they doing? Okay, like the news is actually not made by Twitter, it's made by the users of Twitter. And it just doesn't make sense to me. Now, I'm not saying that people that work at Twitter aren't hardworking or what have you. I'm saying that management is potentially not operating that company in an optimal way. And there's likely some cost savings that could go. And it's really interesting because I guess the Buffett folks, some of them, not all of them, of course, feel strongly that the assets of Twitter or what have you. And I'm like, and they're like big Buffett style investors. And I'm like, hey, you know, Warren Buffett bought Washington Post when everybody thought Washington Post was terrible, and then subsequently sold it to Bezos many years later. But Jim saying it just doesn't, or daily news or something, you know, so it's not like Buffett hasn't purchased a news agency before because he felt that there was something intrinsically beneficial. And it's not like these financials are so terrible given what the costs are doing that you couldn't come up with a way. I mean, this is still fairly strong growth. Look at this top line. So I'm not sure why the negativity is so severe that no one's willing to look through this cost lines items and see like, hey, could we get rid of this? Could we get rid of this? I mean, whatever happened to Six Sigma, but I just wanted to go and just say those things. I will do a more proper video on it when I've had a chance to really look through everything and try to think about it from the perspective of what if I was tasked with making this company profitable? How would I even start to think about it? We'll get to that. The last thing I want to mention is Exxon Mobil. Chevron reported as well this morning. They're both going to buy back a ton of stock, like a ton of stock. It's like in the case of Exxon, I think they're going to do like almost another ridiculous portion of their market cap. I mean, if you just look at how they are using capital right now, they are scared to increase CapEx in a way that will not ultimately end up in more oil or profitability. Those are the two things, because, you know, it's not like you got to find it and then you got to pull it out of the ground, and just like flailing and with business activities that don't necessarily create more oil but spend a lot more money. That's just not how any of these guys are ever going to operate. It's not the right thing to do, but they are absolutely making money because the margins are way higher than they've ever been. Okay. And you know, here's where crude is. It's at the high end. So the blue here is the 10-year range of where prices and margins have been. And they are at the high end of that on crude, way the heck over that on nat gas. And that has to do with the spread and what the demand is and what we're seeing in Europe. And then refining margins are fairly comfortable for the refiners, even though Phillips had a tough quarter. And chemicals is the only place that's getting crushed, but you'd expect that to be kind of inversely related to these other items because, you know, obviously you've got an oil input cost, and you got to try to pass it through, et cetera. But this is what they're seeing in the environment. It's still very, very tight. They are doing the projects that they know make sense economically for themselves and will increase oil. They are increasing both of the companies. I think we're talking about like a low teens, 10%-ish increase in production, which, you know, you still have issues of like getting staffing back to the locations that you need to get them to, that sort of thing. You know, I know a lot of people are really mad at the energy companies because they think they're just making money hand over fist and doing it at the expense of everyone else in the globe. I don't get that impression, but maybe if you're an oil exec and you know, and you want to just write me on the private, let me know. But that's what I'm seeing there. And that is the quick and dirty on earnings that I've seen so far. Let me hit the pause button and take questions.
Hey, May, brilliant call on Amazon.
Yeah.
You know, they were trading at 2,100 pre-pandemic.
Yeah.
Is that, and people are talking about, well, you know, the AWS is growing at 40%, blah, 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 but that's like a small segment of their business. So,
I mean, it is at this point, it's more than all of their income, net income. So even, you know what I mean? Like all of the costs is like, if they could actually shut down all of Amazon, which I think would be the dumbest thing to do, or if they could somehow sell Amazon, but that market cap is so, I don't even know what they'd sell it for, but right now it is a drag on everything. You know, and I think that, I don't know, Andy really has to, Andy Jaffe is a brilliant executive. I mean, I will say that the calls themselves are getting better, even though they're extremely short. He's not deviating from his action plan on how he's going to make Amazon profitable. And that action plan really won't show any fruit until the third quarter, and does kind of require energy prices to go down.
Yeah, I would compare it to pre-pandemic and see if that's going to be where they are.
Okay, let me take a closer look so I can say something more thoughtful, but that's a great idea. I think that's the right call. Yeah. Yeah, I know what you mean. I'm going to have to like compare figure out a way to like modify things for like the portion that is actually making money. Yeah, let me take a look. It's a really interesting question.
Cool, thanks. Okay, say hello to Mr. Buffett.
I will. Knock on wood. It's a little bit of an interesting time. Everybody's trying to jostle for like how they're going to get to the event and all that stuff. It's really exciting. I definitely recommend people check out Omaha. It's a very, like, people are nice here, especially relative to New York. I mean, we're more like edgy in New York. We're not unnice
compared to New York.
Okay, yeah, we have edge in New York. I have to like kind of tone it down every now and then for the Omaha folks who are extremely nice. So yeah. And I'll tell you, the other thing that's really surprised me so far, at least in downtown, it's been a very diverse set of people. Like, people are from all over. And it's not, I mean, locals even, not even. So my impression is Omaha is probably a really cool place to check out if you're anywhere in the Midwest.
Yeah, you know, it looks like, and it may be even worse for Amazon because they really expanded to meet the demands for during the Omicron virus. So, I mean, they've got warehouse space, they've got more, you know, the CapEx was huge. So there you go. I mean, now the business is not there.
Yeah, I mean, look, here's the thing. They did actually, so hold on, this is very interesting. Let me just show you on the numbers. Ooh, did I do this correctly? Okay, yeah, I did. Okay. Yeah, the sales are not there. That is correct. And also I wanted to show you this one thing that is kind of interesting. So here is product sales, right? And you do have it down year over year. And I think that's just interesting in general because the guys that reported, so their quarter ends, I think, so this would have included everything through March. And we do have some folks that report in March, everything through February. So it's like off kilter a little bit when the retailers report. And a lot of them are actually fine on product sales, you know, so this is really an anomaly. Now, in fairness, a lot of that product sales is electronics, because, you know, electronics books a little differently since Amazon actually does have electronics stuff that they sell. But this is, yeah, you're right. This is not good. Services, which includes that 40% uptick from Amazon Web Services. I just don't understand why they do it this way. That is up. So you kind of have to take the portion that is, you know, the 5,000 increase there, and then the rest of his services. So that's your Amazon Prime, the increase that you got from charging people more there. And it's also any other like books that were sold and things like that. Ad services is in there. So it's a really, you know, they didn't really, it's just a very strange mix that we're seeing. Now, the first quarter is weird anyways, if we're really going to try to be fair. And I think they call it the second quarter, but it's, in my head, it's the first quarter because it's the first 3 months. But like, you know, it's a very strange time. I just like, I think shareholder turnover is a real issue. Do you know what I mean? Like, with Google, as much as people want to dump that thing right now, for whatever reason, it's getting clobbered. It seems to be holding around the $2,300 level. The fact is, the issues at Google aren't even remotely bad. You know what I mean? Like, they're actually quite good, given that they had to deal with Ukraine and Russia this year. Amazon isn't in Ukraine. Like that is a big nothing for them. That's not the issue. You might, their issue, COVID shutdown in China was probably a bigger issue for them than Ukraine, Russia. Their issue is that their business model is being tested in an environment where oil prices are really high. And one of their competitive advantages has always been last mile on that business. So it's a little bit tougher. I could imagine some people thinking, okay, do I want to deal with the volatility of Amazon through the third quarter? Do I think of Amazon, if you're owning it, you have to be a growth investor, I suppose. And how do you think about your use of capital on Amazon? I think that there's going to be, if people have put up with it for 2 quarters, are they going to continue to put up with it through to the next, or are some people going to give up? So that's my real concern on buying Amazon today. I just as soon wait, or alternatively buy puts if I'm not going to sell my existing position, just to hedge myself out.
Yeah, I heard Josh on CNBC. I mean, he's pretty sharp, but he was saying Berkshire should look at buying Amazon. I was trying to.
Why?
I know. He said that's their perfect business model, blah, blah, blah. I don't know. Maybe he's on their payroll. I have no idea.
You know what? They say all kinds of things. I mean, like that distribution business, yeah, I don't see it. I don't know another way to say it.
No,
I don't see it. I mean, yeah, no, this is not I think it goes lower. I mean, unless you're just trying to buy, yeah, it doesn't, even if they were to buy it, they would buy stock. They wouldn't buy the company outright. That's way too much cash usage. And you would need it to be a lot cheaper on any kind of valuation metric right now. That's not even a style of investment.
Right.
Like they've got Apple, but this is no Apple. Apple did great on the quarter. All things considered, they did have Russia exposure and they did have China exposure as well. And they went ahead and like a champ did all the financial things that you would normally do on that and still managed to get like top line growth of 10%, bottom line growth of 10%. That's a solid quarter given what happened. Do you know what I mean? He's a great operator. Andy Jaffe still needs to prove himself.
He said the China lockdown did not make the first quarter, did not affect them in the first quarter. It could affect them in the second quarter.
It'll affect them in the second quarter. Yeah, sorry, you're right. But I think he's operating just better, for lack of a better way to say it. Do you know what I mean?
Okay. I'll make you a bet. I bet you see Amazon at 2,100 before 3,000.
It's possible I have some puts on today. I don't think it's going to hold this 2,500 level at all.
Yeah, exactly.
Especially given that next week we still have the Fed to come out and speak.
Okay. Have fun.
Thanks. We'll keep it short. Happy Friday, guys. Be careful in these markets. Bye.